Hello, good morning. You are watching your own news channel, AFK Newsroom, and this is Dr. Ejaz, your host. We are going to explore the American rate crisis as how interest rates are reshaping American life for 330 million Americans on daily basis. Uh, Let me ask you something simple, not an economist, not a banker. When was the last time you checked your credit card statement? Really checked it or not, and felt okay about what you saw? And when was the last time you walked into a car dealership and drove something off the lot without wincing at the monthly payment? When was the last time someone under 35 told you they would found a house they could actually afford? And if those questions sting a little, you are not imagining it. Something real has happened, and something real has happened to the cost of borrowing money in this country over the last 4 years, and it has reached into every corner of American life. Your mortgage, your car, your visa, your kids' student loans, your neighbor's small business line of credit. Today, we are not going to drown you in jargon, but we are going to take the most powerful economic lever in the United States, the interest rate, and explain what it actually does to does to real people. People like a nurse in Columbus and Ohio, a teacher in Dallas and Texas, a small business owner in Milwaukee and Wisconsin, a 26-year-old in Denver who can't figure out how to stop renting. And according to Federal Reserve Bank of New York, it costs more to borrow money today than at any point since the early 2020s, and the most Americans are carrying that burden in silence. Here is what we know right now. In June of 2026, the Federal Reserve's benchmark interest rate sits at 3.5, between 3.75%. The Fed just met 2 weeks ago and voted unanimously to hold it there. But but here's the twist, and this is the part that should keep you watching. The Fed's own officials now think they may need to raise rates against later this year, and not cut rates. The that sentence matters because everything flows from it. Let's start at the beginning. The machine nobody voted for, what the Federal Reserve actually is and why it runs your life. Most Americans have never voted for anyone on the Federal Reserve Bank, never met anyone who works there, can't name the city where it's headquartered, and yet this institution, more than almost any other on the country, shapes how much you pay every month to own a home, drive a car, or carry a balance on your credit card. The Federal Reserve, the Fed, is the central bank of the United States. Think of it as the bank of banks, and it sets the overnight lending rate between financial institutions, which sounds abstract until you realize um, that rate is the foundation on which every other interest rate in the country is built. Your mortgage rate, your auto loan, your savings account yield, and your credit card APR, all of them trace back to one number, the federal funds rate. The sheriff in town on this is a new sheriff in town in simple ways, if we say, on the one side of the picture. On May 22nd, 2026, Kevin Walsh was sworn in as the new chairman of the Federal Reserve, replacing Jerome Powell. His June 17th press conference was his first as chair, and the financial world watched it like the opening night of a new administration. What they heard was not reassuring. If you were hoping for cheaper borrowing, Watch delivered a shorter, crisper statement than his predecessors. He removed the old forward guidance language, the part where the Fed used to hint at where rates were going, and he also chose to not to submit his own dot in the dot plot, the anonymous grid where Fed officials projected future rates. His message was deliberate. I'll tell you what I see today, not what I promise tomorrow. The statement just gives you the fact as the best we can judge it, according to Fed Chair Kevin Walsh, June 17th, 2026 press conference. And the facts, as he judged them, were these: inflation is still too high, the job market is still too resilient to justify cutting rates, and the Iran war's energy shock has complicated everything. The dot plot submitted by the other 18 officials at the table showed the nine of them now expect at least one more rate hike before the end of 2026. Read that again: nine Federal Reserve's officials think rates need to go higher. Here in the January, here is the, I'm sorry, here is the journey in plain English. If I say, in early 2022, the Fed had rates at essentially zero. Then inflation hit a 40 years high. The Fed panicked, not its word, but an accurate one, and hiked rates 11 times between March 2022 and July 2023, driving the federal funds rate to 5.25%, and it then cut rates three times in late 2025. Now, because of the Iran war's energy shock and resurgent inflation, it may hike again. Ordinary Americans did not cause any of that, but they are living with all of it. Then let's start with a number, with a number that should stop you cold: 21%. That is the average annual percentage rate, the APR on American credit cards right now. 21% per year. If you carry a balance, you are paying the equivalent of handing your credit card company one out of $5 you owe, and every single year, just in interest charges. And here is what makes that number devastating: more than half of American cardholders are doing exactly that, carrying a balance from month to month. According to a major report released in March 2026 by the Century Foundation and protected borrowers, roughly 40% of all American adults, that's approximately 111 million people, cannot pay their credit card bill in full each month, and they are carrying a balance. They are paying that 21%. Of those 111 million people, more than 27 million Americans can only afford the minimum payment. They are paying the minimum. You know what that means, right? If you have a $5,000 credit card balance at 21 percent interest and pay only the minimum every month, it will take you more than 14 years to pay it off. And if you will pay more in interest than you originally borrowed, according to there is an example from Maria, 38 years old, licensed practical nurse. She said she lived in Columbus, Ohio. She said, I make decent money, but when gas prices spiked after the Iran things started, I had to start putting groceries on the card. Now I'm paying $180 a month just in interest. I pay it, but I'm not getting anywhere. It's like running on a treadmill that never stops. Maria's story is not unusual. It is the norm. Americans have paid a cumulative total of 2.1 trillion dollars in credit card interest since the year 2010. 2.1 trillion dollars in within just 2010 to 2026, within just 16 years, more than the total amount of outstanding student debt. According to the same report, the entire banking industry earned $174 billion in credit card interest income in 2024 alone. Why is the rate still 21%? Did not the Fed cut rates? To answer this question, we need to know the frustration of Americans, and rightfully so. The Fed did cut rates three times in late 2025. Credit card APRs came down slightly from about 22.3% in question 4 of 2024 bit to 21.5% in question 1 of 2000 in quarter first of 2026. That is a reduction of less than one full percentage point after three Fed rate cuts. Meanwhile, the Fed raised rates by more than 5 percentage points between 2022 and 2023, and credit card companies retouched their rates up in near perfect lockstep. Banks are quick to raise credit card rates when the Fed hikes, and they are very slow to lower them when the Fed cuts. And with the Fed now potentially hiking again, the pressure on credit card APRs is about to point in the wrong direction for borrowers. Credit card banks doubled their profit margins over the last 2 decades. Working families are paying for it, according to protest borrowers and the Century Foundation during March 2026. And a total American credit card debt stood at $1.252 trillion as of quarter first 2026, a 63% increase in just 5 years. Since the pandemic low in quarter first of 2021. The car you can't afford to not buy. In America, car dealership lot sticker prices and family test driving repo truck on suburban streets. Like in America, a car is not a luxury. It is infrastructure. More than three-quarters of American workers drive to their job. In most of the country, there is no other way to get to work. Drop kids at school, or reach a grocery store, which means that when cars become unaffordable, you don't have the option of simply not buying one. You borrow what you can't afford, and pray the payment clears. Americans now owe a record of $1.68 trillion dollars in auto loan debt, and that puts car loans on par with the entire federal students loan portfolio. The average monthly payment on a new car is approximately $680, up nearly 40% from $506 in 2018. Some estimates from JD Power put the average even higher, at $760 per month. That is more than many Americans pay in rent. Deshaun, 29 years old, a warehouse associate, Memphis, Tennessee, said, "I needed a car to get to work, and I couldn't afford what I wanted, so I look a longer loan, 84 months. I did not realize it meant I would be paying for 6 years. I am 2 years in, and I probably owe more than the car is worth. But what was I supposed to do? Quit my job?" Deshaun's experience is disturbingly common. Longer loan terms, 72 and 84, and the delinquently numbers are alarming. The Federal Reserve Bank of New York reported in May 2026 that auto loan delinquency rates have hit the highest levels ever recorded in their data set. Subprime auto loan delinquencies are at their worst in 32 years, when people can't make their car payment. In a country where a car is how you get to your job, the consequences cascade fast. Uh, Total, if we talk about the numbers of car loans, total auto debt is $1.68 at all time record, according to Fortune May 26. Average monthly payment, that is $680, up 40% from 506 in 2018. GD Power estimates $760 per month. Auto delinquency is the highest rate ever recorded by the New York Fed, quarter first 2026. 7+ years loan payments, approximately 20% of average monthly income for lifetime of loan. Then subprime delinquency, worst in 32 years. Car Edge, which February 2026. When this is graphically and statistics of the car loan debts, and when the Fed kept rates near zero through 2021, car dealers could offer attractive financing. When spiked in 2022 and 2023, Those same dealers started offering 7 years loans just to make the payment look meaningful and manageable. And the interest rate did not make cars cheaper, it just stretched the pain out longer. And a student loan borrower default every 9 seconds in 2025. Uh, every 9 seconds, someone, a teacher, a nurse, an electrician who went to a community college, a 38 years old still paying for a degree they earned 15 years ago, crossed the line into default. Their wages are now being garnished. Their tax refund is being seized. Their credit score has been crushed. And here is the background. During the pandemic, the federal government paused student loan payments and interest for nearly 3 years. It was the right call for an emergency, but it created a bubble. When payments resumed, millions of Americans who had normalized not paying suddenly faced bills they had not planned for. At the same time, gas, groceries, and rent were all rising. Here is another example of Jennifer, 42 years old middle school teacher from Dallas, Texas. She said, I'm quoting her words, I have a master degree. I went back to school because they told me teachers with higher degrees earn more, and I earn more, not enough to pay off $67,000 in loan while also paying rent and keeping my car running. I graduated thinking I did everything right. And according to New York Fed data released in May 2026, approximately 2.6 million student loan borrowers defaulted in first quarter of 2026 alone, and on top of roughly 1 million who defaulted in quarter fourth 2025. That's 3.6 million people entering default in just 6 months. The student loan delinquency rate now stands at 10.3% of balances that are 90 or more days past due. Uh, and here is the most frightening part: 7 million more borrowers in the now defunct Safe repayment plan are currently in a court ordered forbearance. When that ends, when those borrowers hit the 9 month mark in the repayment period, the New York Fed warns of a second wave of defaults. An additional 7 million people who have not yet defaulted but are positioned to. A student loan borrower default every 9 seconds in 25 as Trump restarts wage garnishment. This statement was issued by Protect Borrowers January 2026. The average borrower entering default is nearly 40 years old. These are not irresponsible 22 years old. They are mid-career Americans who borrowed to improve their lives and now find themselves at the intersection of a stalled job market, high inflation, and a debt system that offers few second chances. Then, in the summer of 2021, a 30-year fixed mortgage cost you about 2.9%. The monthly payment on a 350,000 dollars home, a modest home in most American cities, was approximately $1,460. Today, that same mortgage cost 6.5%. The same home, the same $350,000 now carries a monthly payment of approximately $2,212 a month. That is $752 more per month, every single month for 30 years. Um, over the life of the loan, the difference between a 2021 mortgage and a 2026 mortgage on a $350,000 home is more than 270,000 in total interest paid, a quarter million dollars gone, uh, because of where interest rates moved. Uh, According to Catalin, 26 years old, a graphic designer from Denver, Colorado, I have been saving for 3 years. I have $28,000 saved for a down payment, but when I run the mortgage calculator now, the monthly payment on anything in my price range is more than I make in a month for a month after taxes. I keep waiting for rates to drop. My friends say I'll be renting forever. And Catalan is not alone. In a May 2026 survey, 62% of would-be home buyers said they were waiting for mortgage rates to fall before buying. The same survey found that 62% said the exact same thing in 2025, and rates did not fall, they went up. The 30 years fixed mortgage rates stand at 6.52% as of Freddie Mac's June 11th survey. The Mortgage Bankers Association projects rates will average 6.5% in 2026 and 2027 and 2028. That is not a near term problem. That is a that is a decade long affordability crisis for an entire generation of Americans who did everything right, saved money, built credit, stayed employed, and still cannot afford the purchase that previous generations used to build a middle class stability. If we discuss in these statistics, we can summarize as 30-year mortgage today, that is 6.52%, according to Freddie Mac Primary Mortgage Market Survey, June 11 and 2026. 30 years mortgage, 2021, that was 2.9%, difference of 3.6 percent points with reference to the mortgage rate of today. Extra monthly payment, that is $552 per month on a 350,000 versus 2021 rates. Extra lifetime interest, that is 270,000, means $270,000 plus over over 30 years on same home versus 2021 rates. Median home price, that is $419,000 nationally, down 2.4%. Listing prices, seventh straight monthly decline. 0 percentage of waiting for rate drop, that is 62% of buyers. Huh. Yep. 62% of buyers are waiting from May 2000, according to May 2026 survey, same as 2025. And yeah, and there's a cruel twist known as the lock-in effect. Millions of Americans who bought homes in 2020 and 2021 with 2.5% to 3 between 2.5% up to 3% mortgages are refusing to sell. Why would they? Selling means giving up a 3% mortgage and taking on a 6.5% one, instantly doubling their interest cost. So they stay, inventory stays low, prices stay elevated, and first time buyers stay locked out. Uh, then small business Americans, and cost of capital, the loan they can't afford to take. We have talked about consumers. Now let's talk about the people who employ them. America has 33 million small businesses. They employ nearly half of the private sector workforce, and they borrow money. They borrow money to buy equipment, hire employees, open a second location, make it through a slow season, and the rate they borrow at, it's directly tied to the federal funds rate. And right now, small business lending rates are at levels that have caused many owners to simply stop borrowing and by extension stop growing. Here is another example. Patrick, 51 years old, a restaurant owner from Milwaukee, Wisconsin. He said, before COVID, I borrowed at 4.5% to renovate my kitchen. I needed to do the same thing last year. The bank offered me 9%. I looked at my margin, maybe 8% on a good month, and thought, if anything goes wrong, that loan kills me and I am stuck with the old equipment. Patrick Patrick, hesitation is rational. When the cost of capital exceeds your profit margin, borrowing to grow stops making economic sense. Uh, Small businesses across America are caught in exactly that trap, needing to invest to stay competitive, but unable to do so at current rates without taking on risk they cannot absorb. The Fed's own data shows that simple business credit conditions have tightened significantly since 2022. Banks became more selective, credit standards tightened, and lending slowed. The businesses that depend most on access to affordable credit, the independent restaurants, the corner store, the family owned contractor, have been squeezed between rising operational cost and expensive borrowed capital simultaneously. uh, The mountain of household debt America is trying to claim, that is $18.8 trillion. Let's put it all together in one number: 18.8 trillion. That is the total household debt carried by American families as of first quarter of 2026, according to the Federal Reserve Bank of New York. It is the highest in American history. And in the current interest rate environment, every single Every single dollar of that costs more to carry than it did 4 years ago. Graphically, total housing household debt is $18.8 trillion in first quarter of 2026, according to New York Fed, highest ever recorded. Mortgages that are 13.19 trillion, largest single category. Auto loans 1.69 trillion, a record high. Student loans 1.66 trillion, 10.3% in serious delinquency. Credit cards 1.25 up to 63% from pandemic now. Overall delinquency is 4.8% of outstanding debt. Delinquency is rising across all types. Credit cards delinquency, that is 13.1%, highest in 16 years. New York Fed report in first quarter of 2026. Credit card delinquency rates are at the highest they have been in 16 years since the peak of the 2008 financial crisis. Auto loan delinquency is at record level. Student loan defaults are surging, and the research shows something particularly alarming. Borrowers who are behind on one type of debt are very likely to be behind on multiple types at once. Nearly 40% of defaulted student loan borrowers are also past due on their auto loans. 56% of them are behind on credit cards. This is not a set of isolated problems. It is one problem too much debt at too high a rate in an economy where wages are not keeping up. Working families are at a breaking point and desperately need relief. Consumers Advocacy Coalition statement responding to New York Fed quarter first 2026 debt report. The one group the Fed just made richer, and what that tells us about how the system really works. Here is the uncomfortable flip side of high interest rates that doesn't get enough attention. If you have money actually saving in an interest bearing account, high rates have been very good to you. High yield saving accounts are currently offering returns of 4 to 5%. CDs are paying the best rates in 20 years. Treasury bills are attractive if you have money to save or invest in fixed income. The current environment is favorable in ways it has not been in a long time. The problem, of course, is that the American who benefit from high rates are generally the Americans who need the help the least. The 70% of the Americans who live paycheck to paycheck, a figure documented in a February 2026 survey of American Federation of Teachers members, are not benefiting from 4.5% savings rate. They have nothing to save. This is a structural unfairness at the heart of monetary policy. When the raises rates to fight inflation, it asks the people with the least savings and the most debt and the lowest wages to bear the heaviest burden, in the form of higher credit card bills, higher car payments, and higher mortgage rates. Meanwhile, the people who benefit from higher rates are those who already have wealth. The vast majority of working families live paychecks to paycheck. A growing number rely on debt just to afford essentials. As American Federation of Teachers members a survey February 2026. What could change and what won't? Uh, scenario is First scenario is the Iran peace deal works and rates come down. If the US Iran nuclear negotiations produce a final deal in the next 60 days and the Strait of Hormuz stays open, oil prices could fall further. If oil falls, inflation falls. If inflation falls towards 3% or below, the Fed gains room to cut rates later this year or in the early 2027. The dot plot projects rates eventually reaching 3% in the long run. If the peace holds, that path accelerates. What that means for you: mortgage rates potentially dipping below 6% by early 2027, credit cards APRs slowly declining, auto loan rates softening. Not dramatic relief, but a direction change. Second scenario is inflation stays elevated and the Fed hikes. If inflation stays above 4% through the summer, as it was in May, and the Fed follows through on its hike is on the table, signals rates go higher. Markets are currently pricing in a 25% basis point like hike by October. That means credit card rates tick up, mortgage rates tick up, auto loan gets more expensive, the debt mountains gets heavier. What that means for you: the squeeze tightens. The 27 million Americans currently making only minimum credit card payments face higher minimums. New car buyers face worse loan terms. Young renters who were hoping to buy in 2027 push that timeline back again. And third scenario is the long plateau. The most likely scenario, according to most economists, is neither a dramatic rate cuts nor dramatic rates hikes, but a sustained plateau somewhere between 3.5 and 4%. Through most of 2026 and into 2027. Not relief, but not a worsening, a slow grinding status quo. Uh, the Fed's own projection shows PCE inflation reaching 3.6% this year, 2.3% in 2027, and finally hitting the 2% target in 2028. 2 years, that is how long the timeline is for inflation to reach the Fed's goal. Too many years of the current environment. Uh, the next is the honest bottom line, and that is what nobody in Washington wants to say out loud. That is, we started today with a question: when was the last time you felt okay about your financial picture? Maria, the nurse in Columbus, is paying $180 a month in credit card interest. She can't eliminate because gas money comes first. Deshaun in Memphis is 2 years into an 84 months car loan on a vehicle that's already worth less than Jennifer, uh, he owes. Jennifer in Dallas has a master's degree and $67,000 in student debt and is one unexpected car repair away from falling behind. Kathleen in Denver has served for 3 years and still can't buy a house. And there are not these are not sad stories about personal failure. They are the predictable outcomes of 4 years of the highest interest rate environment. most Americans have ever personally experienced, rising from near zero to 5.25% and back to 3.75% on top of pandemic era inflation and Iran war, energy shock, and wages that have not kept pace. The Federal Reserve did not cause all of this. Inflation was real, rates hikes were necessary, but the cost of fighting inflation through interest rates are not shared equally. They fall hardest on people with debt, and in America in 2026, that is most simple. That is the most people. Rates are unlikely to fall for enough fast enough to offer borrowers major relief for the foreseeable future, according to bank rate June 2026. Here is what I want you to take from today. The system is not broken, but it is not designed with you at the center. It is designed with inflation at the center, and it asks you to bear the cost of keeping that number in check. That is not a conspiracy. It is the mechanism, but knowing the mechanism is the first step of navigating it. Watch the July 28th uh, Fed meeting, watch the CPI report on July 14th. The two data points will tell us whether scenario A, B, or C is unfolding. We will be here to tell you exactly what it means for you, for your mortgage, your car loan, your credit card, and your future. I am Dr. Ejaz, and that's our program today. Thank you for trusting us with your time. And take care of yourself and take care of your channel, AFK Newsroom. We will be here in front of you again tomorrow with a new story and with a new calculations and analysis from my side. Take care of you and take care of your loved ones. And till then, goodbye.